You're listening to Questioning Your Sense, where you get real-world, pragmatic tax and financial advice for business owners, entrepreneurs, and independent contractors. Here are your hosts, Kevin Molen and Charles Steinmetz.
Hey folks, welcome to Questioning Your Sense. Thanks for joining Charlie and I today. Charlie, we're going to dive right in. I think today our topic is going to be a little bit about tax avoidance. Kind of a somewhat misunderstood concept, but I think we'll be able to provide some clarity. Before we jump in, anything you want to tell me about today?
Sure. We just had our October deadline, and so those who have filed their tax returns are, happy to have them filed. There are some folks who haven't yet filed, and so just some of the stress that may come with it, some worry. To alleviate some of that worry, if you're due a refund, if you know you're due a refund, deadline doesn't matter. Deadline only matters, penalties and interest, if you have an amount owed, because it's a percentage based. And so you charge me 1,000% of zero, it's still zero. So I haven't filed my tax return yet, shame on me, but I'm due a refund. So the deadline, again, doesn't matter. So living testament of, what's the thing? Don't preach it if you don't.
Do what I say, not what I do.
That one.
Sure.
Yes. Living it.
Pretty much the plumber with the leaky pipes, right? The tax professional who has not filed his tax return.
It's amazing. How about you? What are you going to tell me about today?
Oh, yeah, sure. So we actually had kind of a little bit of a scare this weekend. My mother-in-law, who lives in a mother-in-law suite in our house, she had some short-term memory loss issues, which was a little frightening. It almost seemed like stroke symptoms. Things ended up panning out okay, and a lot of clear tests, no problems. We think it was a short-term issue, and so she's recovering and no permanent damage. So it turned out the best you could have hoped that it would turn out.
Sure.
But the point is my wife and I were kind of scrambling trying to get her to the emergency room and all of that. And my mother-in-law has all of her affairs in order. So we knew where the will was. We knew where the medical POA was. They were asking her to consent to things that she really couldn't consent to based on only having about 60 seconds of short-term memory banked.
Sure.
And so my wife was able to provide consent as the medical POA and all of that. And so it really made me appreciate that Bonnie had gone through the effort. And there's costs and stuff associated with it. It takes time. Nobody really wants to do it. We're not in the business of estate planning and that kind of stuff outside of the financials of it. But it really made me appreciate the effort that she went through to get all of her affairs in order and the professionals who assisted her. Speaking of professionals assisting people, let's talk about tax avoidance. So obviously this is kind of a hyped up topic.
Sure.
People use the L word. I hate the L word. The L word is loopholes. Can't stand it. Mini soapbox. I hate the word loophole. But soapbox over. Let's just move on. Beyond that, let's talk about some of the things that actually do help us reduce our tax liability.
Sure.
Not because they're loopholes, not because they're shady, but because this is the way the tax system is built, and each of us should take advantage of it the way that, the best way that we actually can. Right. So start with the most common one, deductions, right? The way that I generally explain to most people that deductions is if you need it or you want it, buy it if it's tax deductible. But if you don't need it and you don't want it, don't buy it. So there's a math to deductions. You want to walk us a little bit through that, Charlie?
Sure. So the deduction side of things, it's the misconception first, I think it's easier to identify, is that if I have $1,000 write-off deduction, then I pay $1,000 less in taxes. And wouldn't that be nice? It's not the case. So the way that taxes work is there are percentages, right? You're in a whatever percent tax bracket, 10, a million, there's no existence. But so any tax imposed on the income that you have, if you're in a lower income, 10%, make it easy math. You have $10,000 of taxable income, you're going to owe the government $1,000 of taxes. Now, if you've already had that withheld from your check, you don't owe another $1,000, but that's how that works. So if you have $1,000 deduction, it doesn't make your tax zero. It's $1,000 off of the $10,000 of income. So now you have $9,000 of taxable income, 10%. Now you have $900 tax liability. So your tax bracket matters, how strong those deductions are, how much tax it offsets. but it's not a one-to-one. That's the most common thing that I will go through and explain is because it's not one-to-one. My thing that I'll say when I'm teaching about deductions, when I'm sitting in my office is, because of that math, what I say generally is, I'm bad at my job of how to go advise you to go find deductions that you didn't have in the first place, right? Can you give $20,000 to a charity? Will it reduce your taxes? That blanket statement alone, as it stands, is technically factual. However,
it's not doing what people think that it's doing.
Correct.
Yeah, what they're really asking, the words that they're using are correct.
Yes.
But what they're really asking, is it going to reduce my taxes by $20,000? Can I pay my favorite charity instead of the federal government?
Correct.
Not one for one, no. But yes, factually you can and write it off. But in the case where you're in a 10% tax bracket, you save $2,000 in taxes. Correct. So you give $20,000 to your favorite charity, and instead of owing $20,000 of taxes, you owe $18,000 of taxes, which, hey, that's great, but it's not doing what you're asking. Yeah. So, I've got some folks who either are self-employed or work in an industry where they have to buy a lot of their own stuff. Mm-hmm. And they'll call me sometimes at the end of the year and say, "Hey, Kevin, I've got about $4,000 set aside for work purchases. What should I buy?" Mm-hmm. What do you mean? What should you buy? Are you asking me to help you decide what you should buy to help reduce your tax liability? Because that's a little silly. What do you need? What do you want?
What's going to help your business? What's going to make it move forward better?
If you don't need it and you don't want it, don't buy it. There are some unique things that you can do, like prepaying expenses for the following year if you think you're going to have a high tax year and that kind of stuff. And there's certainly tax planning and tax strategies that come to bear. But when they're calling me and asking me, "Hey, Kevin, what should I buy?" I'm like, "Hey, I got a great idea for you. Take that $4,000 and bank it. And when you owe $2,000 at the end of the year, right, or when we file your tax return, take the $4,000, take half of it, pay off the amount that you owe, and then pocket the $2,000 remaining."
That's the whole reason you're in business is you're trying to make money, keep your expenses low, your profit high. Sure, you pay more tax, but you have more for what you want. You want to buy golf clubs? Well, we can't use that for your taxes, but you want the golf clubs? Great. Now you have
it depends on the industry they're in, Charlie. But yes.
Don't go down that road.
Yes. Entertainment expenses under the Tax Cuts and Jobs Act were eliminated.
Yep.
So even if you're golfing for networking purposes, generally we couldn't. But as this is a podcast with two professionals, I would be remiss if I didn't throw out the fact that if you were to buy in a sponsorship for a golf tournament or something like that, and participate in that in a marketing way, theoretically we could pick up some golf clubs as at least a portion of them as a tax write-off.
Yeah, I like the reach there. It's really easy and say open a driving range, then you can absolutely deduct.
Oh, sure, that's an easy
it's
one.
It's an absolute part of the business. So
that's an easy one.
There's a definite way. So we've kind of dived a little, not bad, but just the deductions to an individual versus deductions to a business. The math is technically the same in how it offsets the tax liability, but there are differences also in how that can affect the individual, or the business, how it affects the tax return. So on the individual side of things, as we were talking about that, our statements to how deductions work generally affect the 99%. Those few who are in the 1%, where a lot of the misconceptions come from, I think, is if you have just more money than would fit in this room. Which is a lot.
That's a lot.
It can be different on the deduction side of things. So you factor in what other tax will it offset. So you have more money if it's in this room, you're in a high tax bracket. So it's a high percentage.
Yeah, we'll call it 37% is the top tax bracket right now.
Right.
So let's just give some type of context
to what you're talking about. $1 million to a charity, will offset $370,000 of tax. That's a lot.
Yeah.
However, that person who's making $1 million or has $1 million of tax in the year makes a lot more $1 million. Their net worth likely, whenever they pass on, will be in the range of what's called estate tax, which is evil. But that estate tax, think of it almost like a double tax.
Yeah.
And so they're taxed on it when they earn it. They're taxed on it what's going to pass to their heirs. So they're paying 37% tax now. and 40% tax then, you're talking about near 80%. At that, it's different as a professional to look at it and say, maybe you should do this or this, because the difference in almost 80% versus someone who may be saving 22%.
Yeah.
There can be a thing. So just throw it out there. It does exist. There can be some strategic planning around that for that particular individual. I don't know anything like that yet. At some point.
But it also...
But businesses may be different. Sorry.
Yeah, for sure. It also comes to the point of, am I benefiting from spending this money? Right? Because if the answer to that is yes, and the federal government was going to take 80% of it in the scenario that you're explaining, where they're going to take 80% of it eventually anyways, then there is a mindset where that's right, which is I'm getting, if you're going to spend, $1 million on something that is tax deductible, and you're going to get more than $200,000 of benefit from this $1 million that you're spending, then it's a net positive to you because Uncle Sam was going to take 80% of it. But now you're spending $1 million, getting, let's just call it $300,000 of benefit. This is actually, a net positive to you.
Sure.
If that makes sense. That's some higher level stuff, but I think it's a great point to bring around. So when it comes to deductions, generally speaking, you don't want them. So this is one of my gripes with the way that people view deductions. People want deductions. Well, we want the federal government to let us write off more stuff, yes. But once we know what we're allowed to write off, you're not chasing deductions and saying, I want to spend my money on these things. What you want to be chasing is profit, right? And profit is taxable. So if as a business owner, I'm looking at, my outlay, right? I'm looking at my cash flow and I'm saying, okay, I'm bringing in X, I'm spending Y, and the delta between the two is 10%. Do I want it to be 11? Do I want it to be 12? Do I want that profit to be higher and higher and higher? Yes. Well, with higher profit comes higher tax. The idea is that deductions are set up in such a way that you can take advantage of them, right? And we want to make sure we take advantage of every single deduction we can. They're not set up in such a way that I want to spend all of my money on deductions. Right. I could spend 100% of my salary on charitable contributions. I wouldn't pay any taxes. And then I would have nothing. I would have no money. And so I do give money to charitable organizations, but I don't give 100% of my wages to charitable organizations in order to avoid taxes. And so deductions are good. You want to take advantage of every deduction you have the right to take advantage from, but you don't want to chase write-offs. You don't want to chase deductions. Would you agree?
Agreed.
Okay.
Agreed. You did a pretty good job on deductions.
Yeah.
And so is there any other point about super important?
I think we're mostly covered. A whole lot of soapbox.
There is.
In both of us soapboxing there.
Or holding back on them too. Go off, I think, a little bit on those.
Yeah. But do you want to line up the next one? I think we'll want to talk about credits next.
So credits. Credits are ones that do end up working the way that people think deductions work. So $1,000 credit does offset $1,000 of your tax, which is great. And you may be thinking, great, I want those. Let's do credits. I agree. However, credits, generally speaking, just happen organically. They aren't things that can be chased. There are a couple of things that you could look at, college maybe, but on the individual side of things, having a kid, college,
daycare,
adopting, daycare, those are things that you're going to be doing anyway. You're not going to go out and, because I want credit, I want taxes, I'm going to adopt a kid. Please don't have that mindset adopting a kid. That's not the right way to adopt a kid. And so, or even some of the big ones. So I know you had some experience with, didn't you have someone do a geothermal?
Oh, yeah. Yeah. So, in particular, I had someone in a northern state as opposed to the southern great state of Texas that
I was curious about that, if it was Texas or not.
No, it was a northern state. I had somebody put in a geothermal heating in their home for purposes of heating the ground, the floor. And so it's not like those heated bathroom things that you get. And I didn't understand the technicalities of it. There's a reason I didn't become an engineer. But yeah, it was something that was it was energy efficient, geothermal
Powered
on their
the home,
principal
basically.
residence.
Yeah.
Yep, exactly. And so it was pretty interesting, certainly, and it qualified. Now, speaking of that credit is a 30% credit, which is awesome. If you're going to spend, $100,000 on something like this,
It's going away slowly, but yes.
yeah, but theoretically, just the basic
Correct,
math,
yes.
right? You spend $100,000, you get $30,000 as a credit. Well, that's awesome because that's not a $30,000 deduction. That's $30,000. $30,000. I mean, that's for all intents and purposes that offsets exactly $30,000 of tax. And I think we've both dealt with some of the solar systems, right? So the solar energy systems that people purchase. I had somebody purchase one for almost $40,000. The salesperson was telling them that the credit is 30%, so they were expecting a certain amount back on their tax return.
Payout
because of it, to help immediately pay the loan that they had got, because the loan had a balloon payment and all that kind of stuff.
Mm-hmm.
What the salesperson didn't tell them is that the credit was limited to their tax liability.
Because no one's never going to know this.
Yeah, so that actually gets a little bit complicated. Now, I'll try and keep it as brief as I can, but essentially, certain credits, can only offset tax.
Correct.
And so my client's tax was only about $8,000, and the credit that they were hoping to qualify for was about $12,000. But it can only offset tax, and he didn't have $12,000 of tax.
So once you hit zero, it doesn't increase your refund.
That's right. So we got rid of the $8,000 of tax, which is tremendous.
No taxes, which is great.
That's right. Well, and they had paid some taxes in, and so they got that as a refund and all of that. But the refund didn't get to that $12,000 marker, which was what they were banking on. Now, what happens with that credit in particular is if you don't use it all, you don't lose it. The portion just carries forward to the next year. And so we were able to pick up the rest the next year and ended up fine. But the salesperson did not explain that to my client.
Right.
And unfortunately, my client didn't have the foresight to call me during the year when they were considering this purchase. And so, as per usual, credits like this, big stuff like this, don't let that go by. Give us a call. Let us know, because we got to talk through some of that for tax planning purposes. Imagine expecting to get a $12,000 refund and instead owing $1,000 because something didn't work the way that you were expecting it to.
Right.
My gosh, right? My mantra is that frustrations only come from unrealized expectations, and talk about unrealized expectations in that scenario. I mean, that's terrible, and that absolutely can happen. So.
So individual credits, again, one thing, there's a few of them. Mostly they just generally happen. Business credits, you've dealt more with this than I have. They're not just happening. They're more can be planned.
Yeah, there's some general business credits.
Yeah.
There's one. There was a business R&D credit, basically research and development. So in 1981 is when it first was introduced, but only for 2 years. The idea is that was when the oil and gas industry was having a lot of issues. The idea here, economically speaking, at least.
Not just now, then too.
Right. The idea here, economically speaking, is to incentivize these businesses to generate new technology and new products that will always and has always stimulated the economy, right? New products. Think about iPhones. When Steve Jobs announced the very first iPhone, that type of stuff made a really dramatic difference in the economy. Look at smartphones, where they are now. Look at apps, right? Look at things like Uber. Does Uber exist if the iPhone was never made?
Sure, right.
I don't know. Probably not. Now that they're not operating at a profit, but they certainly are giving certain people opportunities to work without having to deal with, being an employee. Those types of economic impacts to stuff like this. I mean, you could theoretically look at these R&D credits as a way to grow technology. Because it incentivizes businesses to invest more into the R&D, because they're looking for ways to benefit themselves while also paying less tax.
Correct.
And so if we open this valve, and they do that, and then they generate new technologies, and then those new technologies improve our economy and our quality of life. Those are all good things for our country. So, anyways, the R&D credit initially in 1981 was introduced, intended only to last for 2 years. It has been off and on until the PATH Act of 2015 made it permanent. And then the Tax Cuts and Jobs Act expanded what it can be used for. It's still, the definitions of that are still super complex. And so don't just dive in expecting the R&D credit to apply.
Sure.
Give us a call. Let us know. We're happy to walk you through it a little bit. But yeah, there's a whole bunch of business-oriented deductions, and there's a lot. Yes, thank you. There actually are also deductions, but
you can only have one or the other.
Yep, our point right now is credits, and so there's quite a few business-specific credits with the intent to help incentivize businesses to reinvest money into their business. But there's like work opportunity credits and that kind of stuff, and it incentivizes businesses to hire people. So now we're not talking about lining CEOs' pockets with these types of credits. We're talking about using these credits to employ people.
Right.
Higher employment generally leads, right? Lower unemployment generally leads to higher quality of life, right? A ton of surveys and polls asking people, right? Usually, I mean, we're in an election year right now. Usually in an election year, one of the most common polled questions is, how do you feel you are now as opposed to 4 years ago, right? How do you feel about your life now as opposed to 4 years ago? What's the way that they ask that question? It's not it's, are you better off now than you were 4 years ago? It is the way the question is asked. And so generally you can link that directly to low unemployment rates, right? The lower the unemployment rate, the more likely people are to answer that they are better off now than they were 4 years ago, which is really interesting. And so right now, obviously right now in the midst of the coronavirus pandemic, that's going to be a little unusual, but leading up to prior to the pandemic, most people were saying that they are better off now than they were 4 years ago.
Sure.
And the best indicator of why that was because of the really, really low, historically low unemployment rates. So really interesting.
One last on the credits, I think, is one called the foreign tax credit. Again, it's one that generally just happens. It happens mostly in two ways. There'll be some people that through just organic investments that you have in a brokerage account, there may be some of the investments that your financial advisor or planner has put in some overseas stocks. Those overseas stocks or securities have to pay tax to that country. You don't pay tax twice. So if you have income from a different country, this will work for whether you're actively working or sell a home or have investments. Almost every country has tax treaties. And so if you pay tax to one country, the tax that you pay to that country counts as tax against whatever tax you would pay to the other country. So let's say, for example, Australia, technically their base federal tax is higher than ours. And so I met with someone who had some income, so he worked in Australia. And so he paid tax to Australia. When we did the U.S. tax return, we counted all the Australia income and all the Australia tax that he paid. And because theirs was higher, you didn't get a refund for it, but at least eliminated the U.S. tax. So it's not you're getting taxed twice. Generally, that's what the foreign tax credit is. Just acknowledging, hey, you're only going to pay tax at the highest rate, whatever it is. If theirs is lower, then you get a credit against ours, and then you pay the difference. If theirs is higher, then it's just offsets what it would be on our side up to that point. And so there's that foreign tax credit. So again, it exists. It's a credit. It offsets your tax liability, how much you have to pay into the system or how much you get out of the system, 1-to-1. But again, on most of these, on the individual side, they just happen.
Yeah, and that one in particular is pretty complex, or at least it can get
very
pretty complex. Yeah. Okay, so talking about tax avoidance, we've covered deductions.
Yep.
I think we're good on credits, right? Was there any other points you wanted to make? Okay, so we're good on deductions, good on credits. So now let's get into some of the interesting stuff. I'm going to say a phrase, and people are immediately going to think that it's potentially something shady or questionable.
Bad connotations.
Yeah, so tax shelters. Okay, so let's talk about tax shelters. The absolute most common tax shelter is a 401k, right? And there's nothing shady about your employer offering you a 401k. In fact, it's fantastic and awesome and amazing. And so tax shelters inherently, there's nothing wrong with them. There have been a lot of different types of tax shelters over the years. And some of them have been, yeah, to say the least. But as most of those have gone away, honestly, there are very few, corporate type tax shelters anymore outside of retirement accounts and such. So one of those is the oil and gas industry. There are still some tax shelters that exist there, but by and large, most of those are no longer corporatized. They're mostly held within the federal government themselves through retirement accounts and that kind of stuff. So speaking about them, first in regards to retirement accounts, 401ks and traditional IRAs. SEP IRAs, solo Ks, those types of retirement accounts are essentially the same in the sense that you put money in and you get the deduction, like we talked about deductions earlier, right? Mm-hmm. You get the deduction upfront. So if I put in $50,000 into my solo K because I'm self-employed, then or a SEP IRA is a self-employed plan. But anyways, the point is, if I put in $50,000, right? If I meet the requirements to put in $50,000 into one of these, I don't get to pay $50,000 less in taxes. The federal government is not funding my retirement account, right? I'm putting in $50,000, and if I'm in a 10% tax bracket, then I save $5,000 in taxes, right? Which is great. But I'm still out $45,000. Right. But now my investment account has $50,000 in it. Right. So the idea there is that you're printing money, right? That $5,000 at least is $5,000 you would have paid. Now you don't, and it's in your account. So that's a little bit of a different way to look at it, but it's one example that I use. Or if you're in a 20% tax bracket, you put in $50,000. And now you have $50,000 in your account, and you don't have to pay the $10,000 in taxes that you would have. Mm-hmm. And so
that's the initial investment. Do you personally view the growth of it as a tax shelter as well?
Yeah.
It's deferred,
yes. Absolutely, because it's tax deferred, right? Sure. So, for example, let's say we put money in a brokerage account, right? That's what the financial industry calls a taxable account. Okay, so you put money in a taxable account, and you purchase 1,000 shares of Apple stock, and that's a dividend-paying stock, and so you receive dividends on a quarterly basis.
Your account grows.
Yeah, from
cross your fingers, but your account grows.
Well, whether the
soapbox. It's going to happen.
I'm going to have to soapbox this. Yeah. So because there's a lot of misnomers here. Whether the value of the Apple stock goes up or down is irrelevant until you sell it.
True.
Right. So no matter how good it gets, and no matter how much your net worth increases, I had somebody that had Apple stock from 1991. So imagine what happened to the value of that stock.
Sure.
Because they had it in 91. Holy cow, right? And this is not an Apple focused podcast, by the way. They have really good brand recognition. So I was talking about the iPhone earlier, and I'm talking about Apple stock.
Sure.
I'm not promoting a certain product. I'm just using it as an example, right? But in that scenario, someone had stock from 1991. The stock skyrocketed, right?
Sure.
Really incredible gains. But those gains were never taxable until my client sold that stock. And once that stock was sold, we had to deal with a lot of tax implications. Right. And so, in the scenario of a taxable account, the value of the stock, let's set that aside, right? That's irrelevant.
All the buys, the sells, the dividends, the interest, all that stuff matters every year.
Yes, the sales matter dramatically for income tax purposes, depending on the appreciation of the stock.
Right.
More importantly, the consistent taxes that you're going to pay, though, are on the interest of the bonds that you purchase. The municipal bonds are a different matter, but in interest that you have from any type of marketing money that you have set aside, dividends from like the Apple stock is a dividend paying stock on a quarterly basis. They may pay a dividend. You have to pay taxes on those dividends as you receive them. But as this money is in a retirement account that's tax deferred, you don't. So it does absolutely shelter you from tax at the time that you've got money in this account and it's growing. And so retirement accounts are one type of tax shelter. Nothing wrong with them. They are fantastic and amazing, and you should have a portion of your paycheck directly going to these accounts.
Right.
No matter your circumstances, whether you are your own boss and you're self-employed, whether you are an employee, a working stiff, whatever you want to call it, whatever you have going on, a portion of your earnings should be going to these retirement accounts. Obviously, it helps you pay a little bit less tax, but then the money grows over a period of time.
Gotcha.
Beyond retirement accounts, let's talk about rentals for a moment.
Sure.
So rental real estate. Sometimes you get the real estate bug, and you just want to dive into it.
Right.
You know, our producer Clark Boyd recently got into real estate. His mother's been in real estate for a long time, and so he got bit by that real estate bug, and has been enjoying some of the fruits of his own labors, many labors. But anyways, let me dial this back down specifically in regards to tax shelters. Generally, professionals like us, we're not going to think of rental properties as a tax shelter because it's really not. But purchasing a rental property, there's a lot of deductions involved with that. Maintaining a rental property, a lot of deductions involved with that. Generally speaking, and I really am being general here, you will pay less tax on rental profits than you will on wages earned.
Right.
There are several reasons for that, but we don't have the time to really dive into rentals, though I fully expect we will have a podcast episode entirely devoted to the taxation of rental properties. In fact, I see my producer making a note, and so I think that he's going to have us jump on that.
Technical episode.
It will be. Don't let your eyes glaze over. Yeah. Anyways, so with rental properties, you pay generally less tax.
Sure.
I personally like rentals. I've mentioned this to you before, but having read Rich Dad Poor Dad, which if you have any interest in rental real estate, I highly recommend Robert Kiyosaki's book, Rich Dad Poor Dad. Really a fantastic book. If you don't have the real estate bug, you'll probably get it after reading that book. It's awesome. But generally speaking, lower tax implications on rental properties. Last, you want to give us a little bit of context on business entities, on sheltering some of your income as a self-employed earner through business entities.
So, yes, my outlook on this may be off. I may need some correction on that because with you starting with this, the whole loophole, tax shelter, tax
Don't
avoidance.
Use the L word, Charlie.
Right. Well, those kind of things have bad connotations to me. And so when I look at this, I look at people's conception, the bad conception, I think that starts with it is I have X amount of dollars and I want to put the same X amount of dollars somewhere to pay less tax now, kind of like a deduction, but I still want to have all those access to those funds. And so, like I see in the movies, I want all these shell corporations or whatever to set this stuff up so I can avoid all this stuff. And it's the case, right? It doesn't exist that way. Even the rental property, the retirement account, even with businesses, it's utilizing the funds that you have and putting them in a way that they will grow, but that growth, the gains you're getting on that, you're paying reduced or less taxes, or it's just suppressed for a duration of time. And so someone who may be, self-employed is looking at that, and you have some income, you have your deductions, you have your stuff, you're able to offset a lot of that profit. But looking at it in a tax avoidance way, my mind just refuses to think this way.
No, I totally understand. So the next piece of that, because I agree with everything that you said. The next piece of that is, I'm spending money already.
Right.
Could that money be tax deductible? Right? Because if the answer to that is no, then I have to start going and looking out for something that can be deductible if I need some deductions. Right? So, but the reason we talk about business entities, and when we talk about business entities, we're talking about, generally speaking, a lot of people will use the word LLC. Charlie, what does LLC stand for?
Limited liability company. It's state designation. Buyers does not care if you have an LLC or not.
LLC. Well, I'm sure we'll have an episode on LLCs. But LLC is limited liability company, not limited liability corporation.
Right.
So you could be an LLC and a corporation, but an LLC is not inherently a corporation.
Right.
So we're going to set the LLC aside for a moment. Partnerships, S corporations, C corporations, and a few other types. But generally, those are our business entities that we're talking about. We're talking about an entity that is federally recognized.
Correct.
Meaning it's not you as a person paying taxes. It is the entity. Well, I don't want to go that route. Let me
You filed
take
paperwork.
a step back.
They gave you back paperwork that said you're a corporation. They have to file paperwork with us every single year.
Yeah, so the
paperwork.
business entity recognizes income and deductions. A couple of business entities actually are not taxed, and we can dive into that a little bit. But for purposes of the partnership, the S corporation, the C corporation, as a business owner that is operating a profitable business,
There, what you want.
Yep, there are more deductions available to you than someone working as an employee for a corporation, right? And so what happens here is, well, I've got my cell phone, and I use my cell phone for business, and I use it for personal, but it's registered under the business name. The business deducts 100% of the cell phone costs: the purchase of the phone, the charger, the case, the Bluetooth, the data, absolutely everything. The corporation deducts it.
Sure.
But me, as Kevin Molen at Molen and Associates, I use my phone for work. I don't deduct the cost of my phone on my tax return because I am not the owner of Molen Associates. You pay for your own cell phone.
Yep.
You don't get to write off your cell phone here at work, even though we were texting this morning, right?
Yep.
For work-related purposes.
I'll just put in there, if Molen Associates ever wants to pay for my cell phone, I will never turn that down. Just saying.
Yeah, okay. And so the idea here is that there are things that are deductible as a business owner that are not as an individual. And that opens up tax shelter. It really, that's also kind of belongs on the deduction side of things, but it opens us
just the general sense of if you can do the same job and be in business for yourself or be employed by someone, the same expenses that you incur either way, the being in business for yourself, you
pay less
good
tax.
chance of having less tax overall.
Yeah. So, and that gets super complicated. Yeah. So we're not going to dive, real deep into that because just again today, the idea is we're talking about tax avoidance, how to pay less tax legally, but also intelligently. Because if I want to pay less tax, I can guarantee that I'll pay less tax by giving 100% of my wage to a charitable organization. But then my kids are not going to be very happy with dad when he gives away all of our money. And so there is a threshold. There is a kind of a line you want to walk. And you're not looking to pay $0 in tax. You're looking to not pay a single dollar more in tax than you absolutely must. So I think that's generally the goal. And if it means that you have to pay $1 million in taxes, that's good.
Good problem.
That's a great problem to have. Now, as long as the $1 million of tax is the absolute lowest you could have possibly paid. Okay. So I think that covers deductions, credits, and tax shelters. Hopefully some of those misnomers were ejected out of your brain after hearing a couple of professionals talk about how these really work. Don't chase deductions. Credits generally just happen. And there may be ways to pay less taxes through putting money in retirement accounts, setting up a corporation in what you do, and the like. So hopefully that gives you a couple of tips. Other than that, I think we're square with our tax avoidance for today, Clark. So that means we want to jump into the comfort zone. You ready?
I'm ready.
Okay. Do we have any questions for our comfort zone today?
Yes, we have 2 questions today. The first one is right in line with the topic. Can I deduct my car that I drive to work?
Fantastic.
You want 30 minutes on that one?
Without any more context, the quick answer to that is no. Right? Without any more context, if we want a quick answer, the quick answer is no. But the longer answer requires a few questions like, are you self-employed? Or are you a contractor? And that kind of stuff.
Generally speaking, you're commuting miles, driving back and forth to work. Miles, tolls, parking fees, not deductible. They're personal miles. Doesn't matter how far, how required, what you're carrying, doesn't matter. Generally speaking. So if you ask it in that way, then absolutely, our answers are the same. But there are circumstances where things could be different, where a contractor driving job site, circumstances will be different that it would allow different things. Do you want to take a couple of seconds and dive into the difference on deducting vehicles, or just answer the question?
No. Let's just answer the question.
Got
Let me give one other point here though, and that is commuting miles are not tax deductible. The question isn't, can I write off my commuting miles? The question is, can I call this something other than commuting miles?
Sure.
Because there are ways for you to be like business use of home, for example, right? So if you office out of your home, you are not ever driving from home to work. You are always driving from work to work. Work to work is not commuting and is deductible. That's a very specific strategy that we use very often. Now, qualifying for business use of home is a little difficult, but if you're a business owner and you own land and a building that is where your primary job is, and you work within the business yourself, and you commute to and from that primary work location, even then, it's commuting miles. It's not tax deductible. Commuting miles are never deductible. Almost ever. There are very few cases in which you can, but there's a way potentially to label them something other than commuting miles.
Great, thank you. The next question is about buying a new house. So the question is, I want to start looking to buy a new house. Is there something I can do to make sure that my finances are all in order before taking this big financial step?
Oh gosh. Okay. It feels like every question is a 30-minute question.
Yeah.
Yes. If this is a yes or no question, yes, there absolutely is. There are things that you can do to help make sure your finances are in order. At least from a tax perspective,
sure,
you need to be currently filed, right? Beyond that,
because you're going to want a couple of years of your tax returns.
Yep, and they're going to have you sign a form 4506T that provides them the authorization to pull what are called transcripts from the IRS. A lot of times,
super redundant. Why do I give you them and give you authorization to have your sign authorization to be done? But
I'm going to answer that actually.
All right,
I'm actually going to answer that.
I've been frustrated for years.
So if I give them a copy of my tax return, and I give them authorization to pull transcripts, what they can see is what I filed with the IRS,
correct,
and what I gave the bank, because those are not always going to be the same. For a long time, actually, it was common practice to do what's called a mortgage-only return. And so some shady tax offices would prepare a tax return that showed you as highly profitable.
Right.
And you gave that to the bank. But high profit also means high tax. And so you gave that one to the bank, but you didn't give that one to the IRS. You gave a different one to the IRS that had more deductions. And so that is absolutely 100% why they ask for a copy of your tax return and the 4506T.
So I agree, except just after the 4506T in the first place and ignore the other one.
I know.
Now, if they're trying to see, are you a liar or not? I mean, I guess.
Yeah,
other than that.
It could be. I'm not sure. But beyond that, there's a lot of things that you want to do to make sure that your finances are in order. But before you go paying off debt and that kind of stuff, you probably want to engage with a loan officer upfront, because you may think that zero debt is better when talking to a loan officer to try and get a mortgage. But the reality is if you pay off too much debt too quickly, then that actually can show up as a negative on your credit score, and it can show up as something that is detrimental to you getting a mortgage loan. So talk to the loan officer with all your debt first, even if you have some money banked in order to pay off that debt. Something that's really, really common is people sell a house, use the proceeds of the home to help fund the purchase of the new home.
Sure.
And so what they'll do is they'll pay off all their debt, and then now they have less money to put down on the house.
Right.
And they think it looks better to get a lower interest rate. But what ends up happening is it hurts their credit score, which hurts their interest rate.
Right.
So their interest rate is higher than they were expecting because they paid off their debt, and they have less money to put down, which means they can't buy down points and that kind of stuff to get a lower interest rate. So I mean, I can keep going. This is a complex. It actually is not that complex. It is an in-depth answer but I hope we gave you a couple of points that are helpful.
I'd like to chime in one thing on
Yeah.
just one of your prior soapboxes is as far as getting your finances in order to buy a home. Please consider the prior soapbox of just because I can afford the monthly payment means that I can afford it. And so when looking at a home, it's really easy to look at a house. It was not too long ago that I bought my home, and looking at a home that's $120,000 and a home that's $130,000, look at that. The base principal payment is a difference of like $70. And you're going, I could do $70 more,
Yeah.
right? I could definitely do that. But there are other things that come into consideration. Bigger home may have higher insurance, may have more electricity, may have more property taxes,
Yeah.
right? It's there's a lot of factors that go into that. So getting your finances in order, I think, is not just a historical getting things ready for the house. It's a looking at truly what are you diving in an all-in situation. So some of that in depth, not that that's complex, but just it's a big important decision. Likely for many people, the biggest purchase you'll ever maybe repeat times in your lifetime, but a big purchase you'll make. So please put some time into it.
Yeah, and that's a great point. I'm really glad you brought up my own soapbox because I don't have statistics with me off the top of my head, but a large amount of people actually buy too much home.
Right.
You've heard the term house poor before.
Mm-hmm.
It's because people make a good living, but they bought a house that was bigger than they needed. They exceeded their what's the word I'm looking for? Not the cost of living, right? They increased their cost of living to an extent that was probably inappropriate. And so they're house poor, right? Because they can just barely meet their bills, barely meet the mortgage, and have very little left over. Now they have a great house, and that's awesome. And if you want to live that way, theoretically you can. But if you can't afford $500 randomly for a car repair or something like that, especially when you own a home, right? Because owning a home comes with unexpected expenses.
They happen.
Yep, absolutely. Everybody's been victim of that, right? Everybody who's ever owned a home has been victim of oh my goodness, I didn't expect to have this expense. And so, really great point. Thanks for adding that.
Those are all the questions for today.
All right, fantastic. Folks, thanks so much for joining us. Really enjoyed talking about this conversation in particular because I feel like it's such a misnomer. People just misunderstand a lot of the way that tax avoidance works. So we'll go ahead and wrap up for today. Thanks for joining us. If you have any questions or want to submit questions to us, you can find us at www.molenandtax.com. Other than that, we'll wrap up. Thanks, folks.
Thanks.
Thanks for tuning in to this episode of Questioning Your Sense. If you haven't done so already, be sure to subscribe to this podcast, leave us a 5-star review, and don't forget to share it with a friend. If you would like to submit a question for our review on this podcast, feel free to email us at info@molenandtax.com.